Hi class. In this video we're going to look at problem 11-4b, which is very similar to 11-4a in your homework. So I'm on page 551 of the textbook. And P11-4b says the income statement, balance sheets, and additional information for virtual gaming systems are provided. So we have actually an income statement, then they show us a balance sheet, and there's some additional information that involves 5 different transactions or pieces of information. And then it says, prepare the statement of cash flows using the indirect method. Disclose any non-cash transactions in an accompanying note. So I've created a template that looks very much like the one that you'll have for your homework. And this makes it a little bit easier because we actually have all the items that we're looking for in this assignment, which is helpful, I can assure you. So we are going to look at the income statement to start with. So we're doing the indirect method. So when we do the indirect method, we're going to start with our net income, and we're going to make adjustments to that net income to figure out what the cash flows were that were actually provided for operating activities. So to get the net income to start with, you're going to look at your income statement. And this one says the net income was $195,000. So we're going to put that in there. So that's going to be our starting point. And so just as a reminder, we're doing 3 different sections. We have cash flows from operating activities. And in this section, we're going to adjust that net income to arrive at an amount that's actually the cash flows that were provided as part of that net income. So we're going to add and subtract some things to adjust that net income to actual cash from operations, which when we're talking about operations, we're talking about revenue expenses that we use to calculate that net income. And then the next section is the cash flows from investing activities, which would have to do with cash used or provided from any kind of investment activity. So in this case, we've got a sale of an asset and a purchase of some investment in some stocks. And then our cash flow from financing activities is any kind of cash provided or used in the issuance of stock or dividends or borrowing or repayment of borrowing. So all those are financing activities, and the cash associated with those activities would be in the 3rd section. So I'm going to go back up here at the top, and it says we start with our net income, and it says adjustments to reconcile net income to the net cash flows from operating activities. And we have all of these items that we're going to be dealing with. So to me, the cash flow statement is one of the hardest statements to do, and I used to have to kind of keep a little recipe book or cheat sheet or whatever you want to call it of the items that changed our net income amount as far as cash flows was concerned, and whether they were added or subtracted. So that may be an easy thing for you to do, or the easiest way for you to do this until you really get comfortable with doing the statement of cash flows. So we're going to just start at the top and work down. So we got depreciation expense. So this problem is a little bit harder than the first example I gave because we actually have to find all of this stuff in the information given. It's just not a list. So to find depreciation expense, you're going to look at your income statement, and depreciation expense is listed there, and it's $33,000. All right, now depreciation expense is subtracted from your revenues to come up with a net income amount. So we subtracted that amount to start with on an income statement, but that amount doesn't involve a flow of cash. So we subtracted it before, so we're going to add it back. And you can make on if you're keeping a note or list of items that change the net income, depreciation expense is one of those, and it's always added back. A gain on the sale of land, we've got to find that as well. So it's also on the income statement, and it says it's $7,000. And that was a gain, so we added that gain to our net sales to come at our total revenues. So we're going to subtract that amount out on the statement of cash flows. And we're going to do that because we're going to deal with that sale of land down here in the cash flows from investing activities in the next section. So we're going to take that gain out because that's an unusual thing that really should be an investment. but on our income statement, it affected our net income. So we're just kind of moving that from here down here. We'll look at this a little bit later. All right, our decrease in accounts receivable. So to find that, we're going to have to look at our balance sheet. And we have a balance sheet that has comparable years, 2017 and 2018. So we're going to have to find our accounts receivable. In 2017, it was $80,000. In 2018, it was $64,000. So that's a difference of $16,000. So we actually have a decrease in accounts receivable. I'm going to add that decrease back. So if you're keeping a list of things that affect net income, a decrease in accounts receivable, you add. If this was an increase in accounts receivable, we would subtract it. And the reason is accounts receivable goes up and down because we have sales. It's part of our sales. So if we look at the income statement, we record all sales in the income statement, whether we collected the cash now or not. So we recorded sales to arrive at the net income that we have up here that involved no exchange of cash. And that's why we have to adjust for that here, because there were some of these sales that did not involve cash. So then we go to inventory, and again we're going to look at the balance sheet. We have comparable years, so our inventory went from $145,000 in 2017 to $160,000 in 2018. So I'm going to subtract that out. And the reason being, if we have an increase in inventory, that's an increase in an asset. That asset involved some cash payments. So if it's an asset, it doesn't show up on our income statement because an asset's not an expense, it's not a revenue until it's used. And then it's an expense. And so our increase in inventory, if we have purchased an asset, we paid cash for it. So that's why there's a cash outflow here. If we had a decrease in inventory, that would be an addition. So you can put that on your list as well if you're keeping a list. All right, a decrease in prepaid rent. Again, we're looking at our balance sheet. So prepaid rent went from $7,200 to $4,600. So that's a $2,600 difference. That's a decrease. We're going to add that back. And again, it would be a decrease in any kind of prepaid expense would be an addition here. If we had an increase in a prepaid expense, that would be a subtraction. A decrease in accounts payable. We're looking at our balance sheet still. We're going to look down in the liabilities and stockholders' equity section, and accounts payable went from $98,000 to $35,000, which is a $63,000 decrease. So that decrease in accounts payable, we're going to actually subtract that out because we had some expenses that were involved in that accounts payable that we have not yet paid cash for. So we're going to have to adjust our net income for that cash that's involved in that. And again, decreases in accounts payable, you subtract. Increase in accounts payable, you would add in the statement of cash flow. An increase in interest payable. Let's see, on our liabilities and stockholders equity section, we had interest payable of $4,000, and it increased to $5,100. So that's an $1,100 increase. So you'll notice there's a payable, and we're going to look at this other payable here. So there's a decrease, so we subtracted that out. This one's an increase, so we're going to add that. Here's another decrease, so I can probably, we can already tell that we're going to have to subtract some amount out here. So income tax payable went from $29,000 to $25,000, so it was a decrease. We're going to subtract out $4,000. And that gives us net cash flows from operating activities of $158,700. So we've basically adjusted the net income to reflect all the cash provided from operations. Provided from operating activities. So we're going to go down here to cash flows from investing activities, and it says that we purchased an investment in stock, and that is actually on the little list of additional information. It just tells us that on number 1 says purchase additional investments in stock for $95,000. So then this section and the next section is a little bit easier because we don't have to try to figure out, well, was this added or subtracted? It's not quite so hard to identify as it was up here. So if we purchase stock, we paid cash for it, so that's a cash outflow. So we're going to subtract out that for a decrease in cash. And then it says on number 2, we sold land costing $55,000 for $62,000, resulting in a $7,000 gain on the sale of land. So remember up here, I had you subtract out that gain, and I told you we would deal with that later. So we're basically moving that gain down to this next section. So when we account for the sale of land, we're accounting for the sale of the land for the full cash payment of that sale of land, which is $62,000. Now, if we sold land, we got cash for it. So we're going to add that cash back in. And that $62,000, it accounts for the cost of the land plus that gain up here. So we've essentially put that gain in right there. So then we have net cash flows from investing activities of a negative $33,000, which means we actually used more cash than we were provided in our investing activities. And if you look at those two numbers, that makes sense. We paid a lot of money for that in stock investment. We didn't make as much when we sold the land, which is not necessarily a bad thing. Hopefully that investment will generate some revenue later on. All right, cash flows from financing activities. It says we issued some common stock, and that is actually number 5 on the additional information for 2018. It says issue common stock for $60,000. So if we issued stock, somebody paid us some money. So we have $60,000. A payment of dividends, this says on number 4 of additional information, declare and pay a cash dividend of $120,000. So we actually are going to pay cash for that, so we're going to subtract that out. And then on my template, I have a repayment of notes payable. We don't actually have that in this particular problem. I believe in your homework you do have a repayment of notes payable. So if you're paying money for a debt that you have, you're paying cash for that, that's going to be a cash outflow. So you would subtract that repayment amount here, but we don't have one in this particular problem. So then you're going to total those things up. So we have net cash flows from financing activities of a minus $60,000, which indicates that we had actually used more cash in financing than we gained in cash in financing. So now we're down here to the net increase or decrease in cash. So to get this amount, you're going to total these 3 amounts that you had, the cash flows from operating, investing, and financing. So if you total those up, you're going to get $65,700, and that's the amount of increase in cash. The cash at the beginning of the period, you have to go up to your balance sheet, and the cash at the beginning of the period was we're dealing with 2018 here, so the beginning cash in 2018 was the ending cash in 2017. So you actually have to look at the balance sheet for December 31st, 2017 to get the January the 1st, 2018 amount. And that cash was $343,800. So I'm going to put that in there. So we had an increase in cash. This is a cash at the beginning of the period. So if you add these two amounts together, it'll give you the cash at the end of the period, which is $409,500. Now you can check that to make sure you're on the right track if you look at the balance sheet again. So I said if you look at the balance sheet under 2017, that's your beginning cash balance. If you look at the cash balance for 2018, that's your ending cash balance. And on our balance sheet, it says our cash for 2018 was $409,500. So that's a good thing. We match what our balance sheet says. And then the problem also had one last thing. It says disclose any non-cash transactions in an accompanying note. So in our additional information for 2018, it says we purchased $30,000 in equipment by borrowing $30,000 with a note payable due in 3 years. No cash is exchanged in the transaction. So that's actually a transaction where we traded an asset for a liability, and we didn't pay any cash at this point. So we can put that, disclose that down here. Purchase equipment, issuing a notes payable. That's actually $30,000 that we had in that purchase, so we can put that there. And that is actually the only requirement for this was to complete the statement of cash flows, and we've done that. We've disclosed our non-cash activities. So that is all that it takes to do P11-4B.